Good afternoon and welcome to the Elite Funds Maximiser monthly update for November 2015. Sitting along me today is Jeff Saffer. Welcome to you, Jeff.
Hello, Dave. Hello, everyone.
And DMAC as per usual. First and foremost, our agenda for today. We're going to talk about the month in review with that was the Elite Funds Maximiser for October. Now coming into November, what are the ETFs for this particular month going forward? And a bit of a review on what happened during October. Our disclaimer as always, the content of today's presentation or any other Elite Wealth material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. Before making an investing decision based on the general advice presented in any of our presentations, please consider whether that advice is appropriate in light of your financial circumstances. Right, Jeff, the month in review, October. We had a double position in SHY, the iShares 1 to 3 Treasury bond, or ETF if you like. We had two positions in that. Well, what was the reason for having two positions?
Yeah, so obviously the ETF strategy each month has two ETFs.
Yep.
And last month, SHY was the only one to make the cut. Nothing else made the grade.
Yep.
Passed our test.
Yep.
And in that case, when there's nothing else to fill the position, yep, the SHY is like a backup. So essentially it was a default or a backup month. Yep. Because obviously if you rewind a month ago, markets all around the globe and not pretty much in any asset class in any region were going backwards. So obviously the system was saying this is essentially an extreme risk default or safety position.
Yep.
Essentially investing in cash, yep, while we're sitting out of the market.
Yeah, and that makes sense too, doesn't it? Keeping in mind that the Elite Funds Maximiser it's a long-term strategy. So really, us as individual investors using ETFs as our proxy for a long-term fund, so to speak, they're just monitoring positions from month to month with a long-term outlook.
Yeah, and just on that, the system has only goes to full cash really once every couple of years.
Yep.
So it's not common that you would see this.
Yep.
So this is really an extreme measure, and if you think about what we've been through in August, September, and what happened to the local market and overseas as well,
yep,
it's quite with that background, and if you think about what a lot of investors' portfolios were doing a couple of months ago, certainly no surprise that the system was saying, look, really an extreme risk out there.
Absolutely.
Need to be sitting in cash right now.
Yeah, and that's just a measure of volatility as well, isn't it? So throughout September we had the ETF SHY, and also we had half a position in September and then a double lot in October. So this is just a chart of what's happened basically since September through to end of October. And as you can see, the whole, really this is a fairly a low volatile type of ETF, and it's really sort of been moving sideways for a period of time, as cash sort of tends to do during those market timeframes there. And as you said, a bit of a flight to safety. And over the course of the last couple of months, there's just been a small drop in the price of this ETF, Jeff.
Yeah, I mean, you can see obviously the chart is generally speaking, it's been moving sideways for the last 6 months.
Yep.
What's really important, and it's taken a bit of a hit in the last month, the highlighted in red, but what you've got to really take into account is you've got to look at that scale on the right-hand side, the numbers. So in the last 6 months, this ETF has moved between 84.7 and 85.1.
Yep.
Okay, so it is basically as much as not moved for 6 months. So even that, what the move you can see on the chart, in reality is so much smaller than that. Yep. It's really, I would say, almost completely flat for the last 6 months.
Yep, absolutely. All right, so that's SHY, the 1 to 3 Treasury. So just a bit of a summary there, Jeff. It was down 0.2% for the month.
Yep. In contrast, I mean, global shares rebounded very strongly. The Aussie market was up a couple of percent, plus a little bit of dividends.
Yep.
Overseas shares were much stronger, so some of the some of Europe was up, maybe 10% for the month after having been smashed sort of leading up to that.
Yep.
So look, the Aussie market did well, but not quite as well as overseas.
Yep.
And really, Obviously, the Chinese fears of a slowdown or an economic crash in China is what's been spooking the market for the last few months, and that's sort of taken a bit of a back seat. And instead, we're focusing probably a little bit of more on potentially QE. So, in Europe, they've hinted that there could be more quantitative easing or fiscal monetary stimulus. Sorry, potentially we could see some in Japan as well.
Yep.
And that's encouraging people to pump their money into the markets. And after a couple of really nasty months, unless you're in a full-blown, bear market, you're not likely to get the market going down month after month after month. So August was one of the worst months we've seen in
for a long time.
For a long time.
Yep.
Certainly, I think in about 3.5 years.
Yep.
And then we had further losses in September. And obviously, a little bit of a pressure valve has come off.
Yep.
Everyone said, look, we've taken a big hit, and they've just started to put their money back into the market.
Yeah, interesting. Australia, by comparison with the world markets, our market is still really, really struggling.
Yes.
You compare it to the US market in particular, but even overseas markets, we're really struggling to get any directional movement to the upward side.
Yeah,
So
I mean, on the downside, we've basically fallen more than the rest of the world, and then on the rebound, we've actually lagged as well. And it's pretty common where come into work and I see that the Dow was up 1.5% the night before, and the Aussie market's up 0.5% or something like that. So we're really struggling. We've got our own problems, obviously, with commodity prices. The banks have got some challenges that they're facing, and that's a big portion of our market. So we're in our own little sort of world of pain, I guess.
Yep.
The Aussie market's really not performing that well. And when you do see it going up, generally other things are going up more.
Yeah, exactly. So again, just remaining very, very stable. Not a lot of movement during the month, and that's intended to be the case as a flight to safety.
What was interesting is that the SHY fell 0.2% during the month. It was up 0.2% the previous month. So really flat over the last couple of months, despite what's all the volatility that's been going on.
Yep. And there, just as summarised as well, underperformed US and Australian markets, just a bit of a change from the previous month. The review for October there, Jeff, what would you like to say about SHY that we haven't already said?
Yeah, look, I mean, just in terms of performance, obviously a disappointing month for the strategy. It's somewhat to be expected. So, and we mentioned when we got into SHY that if the markets did bounce back, we would underperform. I mean, so it's not a surprise at all, but it's a flight to safety, and that's always going to happen. That if the market continues to melt down, you're going to pat yourself on the back, and if the markets just bounce back, you're going to, in a sense, you're going to regret moving into cash. But the system says to move to cash, so we did that, and even just logically, not just the system was saying to do so, but it felt like the right move as well a month ago, given what we were facing. So SHY was down slightly. Obviously, this month we only had the one sort of double position. So overall the portfolio was down 0.2. In the meantime, the Aussie shares were up about 2.5%, and then add some dividends on top of that. So obviously, really underperformed this month, which is a reversal of the previous couple of months when we've outperformed. So we've given back those sort of hard fought outperformance. And then again, obviously, it's to be expected that we're going to underperform when you get that bounce.
Yeah, absolutely. And I think anyone who's thinking that ETFs are a trading instrument that you can use on a short-term basis and just jump in and jump out willy-nilly, we're really thinking about longer-term performance over a period of time, and that's what the strategy's all about. So
I mean, if you think back to 2008 as an example, or even times in 2011 as well. If you had a couple of bad months and you'd gone to cash, you might be questioning yourself, look, do I really want to sit in cash and miss out what might be a good bounce? Of course, in 2008, that bounce took a year to come, and those that did sit in cash, in hindsight, obviously did very, very well. So this strategy is actually proven to probably give its biggest outperformance when the markets are going backwards, rather than it still makes good gains when markets are going up, but it probably shows its most worth when markets are struggling. So we're happy to sit out a little bit of volatility along the way.
Absolutely. All right. So expected turnaround in the next period. There's some new ETFs for November there, Jeff. I know a couple of images there. Uncle Sam. And we'll go off. We'll lead with Uncle Sam there. So,
so we still obviously last month we had a double position in SHY.
Yep.
It has actually made the cut again as one of the ETFs to invest in.
Yep.
And again, SHY, we've talked about it for a few months now. Again, it's essentially lending money to the American government, short-term loans to the American government, which is why the picture of Uncle Sam there.
Yep.
And then someone possibly even scarier. We've got James Bond there. Just a little funny graphic. The second ETF for the month is a VWAB, which is an emerging markets government bond fund.
Okay.
Obviously, the bond
The
play on
bond
words
theme
there.
Yep.
Okay. So they're bonds, government bonds.
Government bonds.
Okay. So SHY, obviously, short-term US Treasuries. Yep. It's a very large fund, very liquid fund. It has a very low cost because it's not an active kind of investment product. And you can see there that the main investments are lending money to the US government for the next, sort of 1 to 2 years.
Yep, absolutely. All right. And that's what iShares has been doing over the
last 12 months.
The last 12 months there. And certainly just very slowly moving in an upward kind of direction there, but certainly the volatility is quite low on that instrument.
And there's some very small, admittedly, but there's a few. They make monthly distributions of the fund. So on top of the very, very mild sort of, I guess, uptrend, there's a little bit of income on top of that.
Yeah, I think we might have mentioned that in the previous webinar too, Jeff. So key theme there, obviously we've discussed safety in terms of, in a broader context of market risk, a proxy for cash, low volatility, and again, just to expect steady performance. And again, we're not necessarily out of the woods in terms of what's happening in the world at the moment, and it wouldn't take too much to send markets into a bit of a scurry once again. So for the time being, the system is telling us, we're still going to have our part of our cash parked in safety of SHY, but the other half now being distributed into VWAB, Vanguard Emerging Markets Government Bond ETF.
Yeah, so this is again another a bond fund, but a little on the opposite end of the scale to SHY. SHY is two things that essentially make it virtually the safest investment in the world. Number one, you're lending to the biggest government in the world, and number two, you are doing it on a short-term time frame. So this is a bond fund, so it's fixed income, but it's obviously lending to emerging markets, so more, I suppose you'd say, riskier countries.
Yep.
In return, you get a higher return, so a higher risk, higher return, and the bonds tend to be longer term as well. So somewhat similarity to SHY, but also some differences there.
Yep.
You can see the top three holdings. Lending to Russia over the next sort of 4.5 years at a coupon, an interest payment of 7.5%, and you can see that the biggest holding is only 1.6% of the portfolio. So this is something that obviously the money is spread quite widely.
Yep.
You don't want to lend 30% to Russia or Portugal and then they go bankrupt and then you've just wiped out a big portion of your portfolio.
Yep.
So obviously spread across lots of different countries and a lot of different time frames there.
Yep. Okay, good. And that's what's been happening of recent times, and particularly I've noticed from that big move we had down in August. Since then, starting to move back up quite nicely, putting in a couple of higher troughs there at this point in time, or at least one higher trough, and moving in the right direction, Jeff.
And again, there's some income payments on top of that.
Yep.
And the income payments can be quite juicy because obviously emerging markets carry more risk.
Yep.
As a result, they have to pay higher returns to borrow money. So certainly the income payments on that would be a lot higher than they would be on something like SHY.
Yep. Okay. Good. Well, that's something extra for the portfolio as well. So just the key themes with VOWB.
Yeah. So obviously equities, they've had a good month, but there's still lots of volatility there. An interesting chart I saw actually. I looked up about a week ago, and this was credit default swaps in the US. The cost of insuring a portfolio of or debt of lending money to US companies. So as this goes up, it basically says that there's more risk that American companies are not going to pay back their debt, and that's doubled in the last few weeks. Still quite low,
Yep.
but we're seeing some early signs that not everything is as rosy as it could be in the US. So there's still plenty. The I guess the share markets have bounced, but behind all that, there's still quite a lot of
There's some
uncertainty.
risk there. Yep.
One thing that's a couple of things that are interestingly at play. Emerging markets typically have quite a lot of exposure to commodities.
Mm-hmm.
So particularly Russia and Brazil, and
Yep.
mostly oil, and Brazil also sort of iron ore as well. Obviously, we know that commodity prices have taken quite a hit
Sure.
in the last 12 months, and a lot of these countries are facing pretty solid budget deficits. So obviously, the profits have disappeared from that industry. A lot of these countries actually. There's state-owned firms as well, so it's not just that companies are paying less tax, but the government is making less money from its government energy companies, etc. So what we'd look for, certainly in emerging markets, yes, it is at the riskier end of town, but some of these countries have announced some pretty significant economic reforms. Just like we've seen over the last couple of days, Australia's considering, we've got a budget deficit because iron ore and coal have gone down, and we're considering raising GST. It's on the cards. Other countries are looking at doing similar kinds of things to fix their books. So VWAP, as I mentioned, is obviously a fixed interest investment, but it's at the sort of riskier end of that scale. And what we're getting is that the emerging markets that have been struggling over the last few years, their currencies are down about 30% against the US dollar, and this is now encouraging people in the US or with major investable funds saying, look, where can we park our money? Where can we put it to good use?
Yep.
Oh wow, we can just get a lot more bang for our buck by going to emerging markets. So what we've seen is just the last month been looking at fund flows.
Yes.
So money that is being invested into emerging markets versus money that's being pulled out,
Yep.
and that's now positive.
Okay.
So we've seen a lot of money being pulled out of emerging markets for a few years,
Yep.
Or certainly in the last sort of 12 months, and now it looks like they might be pumping back in there. So it's an interesting investment, and we'll see how it goes.
Well, that's really interesting too, because the system, what it's looking for is that money flow. We talk about money flow into, a range of different ETFs, and obviously that's something that it's been picked up on, and hence it's now part of the portfolio. So that's again just if you like, a mechanical aspect of the fundamentals in the background. All right, so the actions for this next particular month, we're going to sell half of SHY. So given that we have a portfolio that has 2 lots of SHY, we're going to sell half of that particular allotment that we have. So that means we will continue to hold what we already have of SHY, but we are going to add VWOB at market open tonight.
Correct.
Yep. Okay, so we'll have Uncle Sam and we'll have James Bond as part of the portfolio for November. All right, that concludes our recap of October and the Elite Funds Maximiser view into November. Thank you for watching, and we'll catch you at the next update.
Thank you.